What's up, everybody? Nate here. And the Federal Reserve just decided to completely pause its interest rate hikes. The Federal Reserve has been raising interest rates for over a year now, as it's been trying to battle inflation and bring it down from its over 40-year high of 9%. But with the Federal Reserve sort of pausing its interest rate hikes right now, its next decision might have a significant impact on our economy. So today I want to talk about why the Federal Reserve just decided to pause its interest rate hikes, all of the details from its latest meeting, and how this decision is going to affect jobs, our economy, and of course, inflation. Now, the Federal Reserve has raised its interest rates around 10 times since March of 2022, and this has all been in a response to inflation. The Federal Reserve has a monetary tool, which is interest rates, that controls the demand for money in our economy. So over the last couple of years, like in 2020 and in 2021, they had interest rates at around 0% in response to the pandemic, but then their interest rates started to go back up as inflation went back up. We had a ton of money circulating throughout our economy, a ton of money was created, a lot of demand both in the labor market and for consumer goods and services also went way up. Of course, all of that was related to the pandemic. But when the Federal Reserve raises its interest rates, well, that means it's a lot harder for people to spend money and inflation goes down. That's because this monetary tool affects borrowing costs. So when interest rates are low, it's easy for people to get a mortgage, an auto loan, you name it, investors to invest on Wall Street. But when interest rates are high, it's a lot costlier for people to take on a loan in the United States. So that's why they're now raising their interest rates, because in theory, if their interest rates are high, people aren't going to borrow as much money and everything goes down. So the first thing you need to understand here has to do with inflation. Like I said before, inflation was really high in 2022. So the Federal Reserve needed to do all that it could with its monetary tool of interest rates in order to bring that inflation down. And now we are starting to see inflation actually come down in the United States. Inflation pretty much for the last 6 to 8 months or so has been dipping pretty significantly. And on the latest Consumer Price Index report, it actually showed that inflation came down from 4.9% in April down to 4%. So the Federal Reserve is sort of keeping all of these numbers in mind, and they're seeing that people are no longer borrowing as much money and there isn't as much spending in our economy. So all of those dollars that were created during the pandemic, well, there's not as many in circulation anymore. So that means that inflation is starting to come down, and the Federal Reserve is keeping all of that in mind with their interest rates. So they're pausing them right now to kind of see what is going to happen in the future. They said in their meeting that they want to kind of take additional information when it comes to their monetary policy and inflation and our economy. So right now they're actually anticipating that inflation is going to continue to drop down in 2023, and that's because of a lot of their interest rates, and it's because consumers aren't spending as much money as they were last year. So they anticipate that inflation is going to be around the 3% mark by the end of this year. They also have expectations for our economy. Before, like in 2022, it was projected that our economy was actually going to shrink pretty significantly in 2023 because of stock market conditions and inflation and a whole gambit of other things. But now projections are going up because the jobs market in the United States is still really strong. People still have a lot of jobs, which means there are people still spending a lot of money despite elevated inflation and despite stock market issues. Now, those projections are really important because they have to kind of keep those numbers in mind before they make a decision today. Interest rates in the United States and how they affect inflation in our economy are lagging indicators. So that means when the Federal Reserve actually raises its interest rates, that effect is going to lag throughout our entire economy, meaning it's not going to affect it right away. It might take several months for the Federal Reserve's interest rates to finally hit our economy and see that demand finally come down. And that's because a lot of that money isn't spent right away. A lot of people, whether they're looking for a mortgage or investors, are going out and trying to invest in a business. They're not going to do that immediately. That money isn't created right away. So that means people can't spend it yet, even though interest rates have completely changed. So there is a lot of positivity on inflation in our economy right now amongst Fed governors. And it's really important to point out that a lot of the Fed governors actually have some pretty differing opinions when it comes to inflation and what future rate hikes are going to look like. Around 9 Fed governors actually believe that there's going to be 2 more rate hikes in 2023, while around 1 to 2 of them said that there could be 4 or more. 2 Fed governors said that there's not going to be any more rate hikes throughout the rest of this year, and a couple actually said that there was going to be around 3 rate hikes. So this just goes to show you that there's a lot of disagreements right now with our economy, even though though projections show that the economy could end up growing, and projections show that inflation is going to come down, and that's really important, especially when we talk about expectations. The Federal Reserve has a job to maintain sort of the stability of our financial system, and that comes down to expectations. They don't want to scare people away from spending money, but they also don't want people to be way too bullish on our economy and go out and spend way too much money. So they have to kind of keep a balance, and that is exactly what they're trying to do with their most recent update. Jerome Powell has said that there is most likely going to be around 2 more rate hikes this year. Now, the Federal Reserve and their rate hikes have completely differed over the last 10 hikes or so. Sometimes they've raised their interest rates by 0.5 percentage point. Sometimes it's been 0.75 percentage point, and other times it's been 0.25 percentage point. So we don't really know what exactly is going to come next, and neither do the Fed governors. They're kind of waiting to see how current interest rate hikes affect our economy, and that's going to lead them into their next hikes if we need any at all. Getting back to sort of talking about expectations though, well, they don't want to scare consumers and they don't want them to go out and spend too much money. So whether or not the Federal Reserve actually raises interest rates in the future, well, that is completely irrelevant to this meeting. Federal Reserve Chairman Jerome Powell said that, yeah, they're kind of looking forward to their next meeting in July, and of course talking about their next meeting in September, but they're not really making any decisions about those days yet. They want to make decisions based on what numbers are right now, so that way in the future they can kind of keep things a little bit under control. If the Federal Reserve came out today and said we're pausing interest rates for the next year and a half, well, that could be a really bullish sign for our entire economy, and it might mean that people go out and spend way too much money. Investors borrow a lot of money because now interest rates are completely stable. They know what they're going to be at, so they can invest accordingly. Same with consumers, same with banks trying to lend people money for a mortgage. So that means that there's going to be a lot of spending all at once, and a lot of overspending is what got us here in the first place. That is one of the biggest contributing factors to inflation. We just don't have the supply in order to meet all of that demand. But they also don't want to scare the American consumers. They don't want to come out and say that, yeah, we're pausing interest rates, but there's going to be 14 in the future because inflation really isn't coming down and there's nothing we can do to stop it. If they came out and said that, well, that could scare investors because now our entire economy could end up crashing because the Fed has to get even more aggressive on rates, and it could mean that consumers are scared to go out and get a mortgage because it's really, really expensive to do so. Or it could cause some temporary inflation because now you have a flood of people trying to enter the market and getting in on an interest rate of today because it's most likely going to go up in the future. So the Federal Reserve is kind of leaving it up in the air, and they're letting people know that yes, they're pausing right now because they want to kind of see how their interest rates are lagging and how those lags are going to affect the economy, but then they also want to keep in mind how that is going to affect the consumer. When it comes to actually cutting rates, this is something that Wall Street has talked a lot about because this means that you're going to have a big economic boom when that finally happens. Now, again, there is a lot up in the air here, but Federal Reserve Chairman Jerome Powell said that they don't anticipate bringing rates down any further because they want to bring inflation down to at least 2%. Like I said before, inflation is at 4% in the United States, so they still have a little ways to go, and it might take them a year or two to finally get all of that demand out of our economy. But Powell and the rest of the Federal Reserve has said that this is going to have a significant impact on our economy in general. It's no secret that the higher those interest rates go, the more pain our economy is going to experience because those interest rates affect everything. They affect businesses' ability to take on debt, investors' ability to take on debt to invest in businesses, consumers' ability to take on debt to get a mortgage or a car loan or even spend on their credit card. So all of this amounts to spending money. It's putting more money into our economy, which, yeah, causes inflation, but also causes economic growth. That growth is going to shrink a little bit, which is why our GDP expectations are also starting to shrink because there just isn't a lot of economic expansion happening all at once. If it's really costly to take on money, well, then you can bet people are not going to do it. So businesses are going to have a hard time keeping people, and they're going to have a hard time maintaining their business. So they're trying to cut costs as much as they can right now, which is why we've seen layoffs, and it's why the Federal Reserve predicts around 3 to 5 million people could end up losing their jobs by the end of their rate hike cycle, simply because interest rates are really high and businesses can't afford to keep everyone. Now that is obviously bad, and the Federal Reserve knows that their interest rates are going to cause a lot of economic pain, but it's also going to solve a lot of problems for the the Federal Reserve, because the Federal Reserve has two major functions. Their first one is maintaining price stability in our economy. So with them raising interest rates, they bring demand down, and that means people don't spend as much money as quickly, so there's not as many price fluctuations, which is what leads to heavy inflation. The other thing that the Federal Reserve has to look at is maximum employment. So there is a maximum amount of people that can be employed in the United States at one time, according to the Federal Reserve, and they believe we have long passed that number. So they want to bring prices down by bringing demand down and thus also raising unemployment, so there's not as many people out there spending as much money. But it's not because the Federal Reserve is this big bad agency, it's because the Federal Reserve has a duty to the United States economy to keep the United States dollar really valuable on the global stage. You got to remember the United States dollar is the reserve currency of the world, and what that means is countries all throughout the planet have United States dollars in vaults, and they use United States dollar to facilitate trade and to buy things and to take on more debt. The reason they do that is because our economy is really solid and our money is really valuable, and of course our military is strong too. But if our money suddenly has a big inflation problem and the buying power suddenly goes down, well, now a lot of countries are going to be thinking about the US dollar, and they're going to be thinking about how they can trade it out for something else. They want to do business in a currency that is going to continue to be valuable. They don't want to hold a bunch of US dollars if US dollars are completely worthless. So if we have high inflation, that's when a lot of other countries start to trade out US dollars. We've already seen this happen with countries like China. That affects the United States government ability to pay back its debts and take on new debt, and that is a big problem for our federal government, because now the federal government doesn't have as much money to do all of the things that it needs to do. Fund our military, fund social programs, fund anything. Because the federal government is in a huge tax deficit, and nobody wants to be taxed even more to kind of make up that deficit. So that's how the federal government gets more money. They borrow and get more debt, which isn't the biggest deal in the world, because again, the US dollar is the reserve currency of the world. So other countries want to take on our debt. Other countries want to use US dollars because we are a strong economy. But the second the United States dollar becomes completely devalued and other countries don't want to use it anymore, well, now we have a huge problem with over $32 trillion in debt. The Federal Reserve also wants to prevent that, and that is a problem that they can actually prevent with their interest rate policies. Now, I'm not saying that it's the best decision. I'm not saying that our entire system works fairly for any American or investor out there, but that is the system that is currently in place. That is the system that the Federal Reserve is trying to keep up by raising its interest rates. Like I said before, the Federal Reserve has decided to pretty much pause its interest rate hikes because they want to kind of see how their past interest rates are going to affect inflation in our economy and the jobs market over the next couple of months. And if those things are massively affected and they like the numbers, then you can expect to see more pauses or potentially more hikes in the future. As for cuts, they've hinted at those are not coming anytime soon, but that could change too, as we've had a lot of volatility in our economy with the stock market and the banking sector. And if we have a lot of unemployment or a lot of people who are unable to buy anything, well, interest rates would stimulate the economy, and that's something that the Federal Reserve always has on the table. So it's really up in the air on when interest rates could actually get cut right now, but they're saying it's going to be a couple years. What you need to keep in mind here is you have no control over what the Federal Reserve does with its monetary policies. Even though they affect you directly, you don't have any say over if they raise interest rates or lower them. That means you need to be prepared for both scenarios with your money. You need to know how to spend your money. You need to know how to capitalize on opportunities when inflation is high and when inflation is low. Financial education is the key to do that, and it's really important to have today, because I can guarantee you that issues like this are going to come up in the future. It might not be tomorrow, it might not even be next year, but eventually we're going to see inflation or other economic issues, and you need to be prepared for it. So focus on what you can control, which is your own money and your own education, and make sure to stay up to date with everything going on in the business and financial world. Now, if you want a super easy way to do that, we are talking about everything that's happening 7 days a week over on this channel, and if you're ready for another video from me, be sure to check this out before you go. Let me know in the comments below what you think about the Federal Reserve pausing its interest rates. Do you think this is a great move and that they're going to start cutting them sometime in the near future, or do you think the Federal Reserve is actually going to raise them a lot higher because inflation simply isn't going away? That is it for me, everybody. Be kind out there, and I'll see you all in the next one.